After the agenda consultation project, FASB published this chart that shows top priorities identified by groups of respondents, practitioners, meaning accounting firms, preparers, and investors and investor advocate groups. As you can see, the areas of focus are different by group. Practitioners highlighted nuanced issues such as the indexation guidance within distinguishing liabilities from equity, something that challenged and kind of gave unexpected accounting outcomes. Preparers focused on the bigger picture items, such as aligning hedge accounting with how entities manage risks. And then investors and investor advocate groups brought up areas where the usefulness of reported results and disclosures could be improved, such as pertaining to the statement of cash flows. All of those have now either made it to the FASB technical agenda or to the FASB research agenda. I don't think I touched on the equity method of accounting changes that are being considered, but essentially they are to make the equity method make more sense for partnerships and LLCs. The existing guidance essentially says that non-authoritative but widely applied, that if you have more than 3 to 5% ownership in a partnership, that you're automatically under the equity method. That will hopefully go away with that standard. Colleen, any action that you want to see from FASB?
I think that really depends on what your client base is. For me, like that, the equity awards, the profit interest is a pretty meaningful one in financial services. In the fund world, the phantom unit classification of 718 is always a really challenging analysis that we do. In addition, the CECL updates is sort of codifying, I think, for private companies, what's been happening in practice on trade receivables. But there was, during implementation, there was a significant uplift to get, CECL policies in place for anything held at amortized cost. So it is welcome relief for public companies, for private companies. And I think that a lot of them are looking to early adopt that one. What do you think, Sergey, as far as impact here for the 26?
Yeah, in terms of the standards that are coming effective, I agree. The accounts receivable CECL change, I think that one flew under the radar a little bit, but it is kind of a meaningful relief, especially for private companies. The guidance is slightly different. It came out of the private company council process, but there are parts that are applicable to public companies as well. Now, one thing I should note that any of just about all of the final standards that we've talked about on this presentation can be early adopted. So there's something that's coming down in 27 or 28, but it makes sense for your company to apply now. You can do that. In part because of the agenda consultation process, the agenda, so what the topics that FASB is currently working on, it's got commodities coming out of the agenda consultation. There were some financial institutions that essentially expressed that for them it makes sense, and for their financial statement users makes sense if they measure commodities at fair value rather than cost, and that will be made as a policy election specifically to financial institutions. So that's the first area highlighted on here. Then debt exchanges, that is a long-awaited project. It's been on the FASB agenda for, I want to say, at least since last year, if not longer. Definitely longer. It would make some debt exchanges be automatically treated as extinguishments. So without having to do the 10% test, if debt is being exchanged, the same lender, you would not have to, you would treat it as an extinguishment without having to do, so that would simplify accounting a little bit without having to do those tests. However, the project is now on pause. FASB is evaluating input from the invitation to comment. Some would touch this area. So no longer immediate action on this one. In addition to making the equity method more applicable to partnerships and LLCs, would also formalize the earnings methodology that previously was applied by analogy from real estate guidance. So essentially using the waterfalls that are in the LLC agreement instead of just the percentage of membership units held in order to allocate earnings of an equity investee. So that was a hypothetical liquidation method that came from real estate guidance would become applicable to other companies as well. And finally, the indexation, so debt and equity update or topic rather. So under this topic, it is proposed that an instrument would be considered indexed to an entity's own stock, as long as the variables that affect the settlement amount are related to specific specified acceptable variables. The entity's own stock price, strike price of the instrument, term of the instrument, expected dividends or other diluted activities, stock borrow costs, and several others. We have had clients fail equity classification because, for example, the number of shares to be issued depended on the issuer's EBITDA, and that would no longer be under the proposed topic or standard to be proposed, where we're expecting an exposure draft. So we don't have an exposure draft yet. That is the next step. But we expect that exposure draft will expand the number of criteria that can be considered in an instrument without losing equity classification. So more instruments will become equity classified